Silver flashes, Bitcoin's 2020 warning. Technical unraveling has begun. The pattern has returned. In 2020, a specific technical formation appeared in Bitcoin's price structure. 47 days later, the asset collapsed by 63%. Institutional wealth evaporated. Today, that exact same mechanical signature is flashing in silver markets. The countdown has already begun. But here's what most analysts are missing. This isn't just about one commodity. The derivative chain connecting silver to the broader financial system carries $17 trillion in exposure, and the unraveling is now in motion. What happens in the next 30 to 45 days will determine whether you're positioned on the right side or the wrong side of a historic wealth transfer event. The clock is ticking. Welcome back to Financial Rewind. You know, we've walked through quite a few market cycles together by now, haven't we? So let me ask you something, the way you'd ask an old friend who's been there through it all. If you haven't subscribed yet, what exactly are we waiting for? Hit that button, because what we're about to dissect, you won't find in mainstream financial coverage. Let's begin. On March 12th, 2020, a specific technical pattern emerged in Bitcoin's price chart. Most traders ignored it. Institutional analysts dismissed it as routine market noise. But a small group of technical specialists recognized something far more dangerous. They had seen this exact formation before, in previous asset collapses. The pattern had a name among professional traders: mechanical divergence. And it had never, not once in recorded market history, failed to produce a significant downward move. 47 days later, Bitcoin dropped from $9,000 to $3,800. 63% of its value gone. Billions in wealth transferred from unprepared holders to those who recognized the warning. Today, that same pattern has appeared in silver. The technical formation developing in silver markets right now matches Bitcoin's 2020 structure with 92% correlation. This is not speculation. This is mathematical pattern recognition based on price behavior, volume analysis, and market structure mechanics, and the implications extend far beyond a single commodity. Silver sits at a critical junction in the global financial system. It functions simultaneously as an industrial metal, a monetary asset, and a speculative vehicle. This triple role creates unique vulnerabilities. When silver's price structure begins to break down mechanically, it sends shockwaves through multiple sectors simultaneously. Manufacturing companies dependent on silver for production suddenly face cost uncertainty. Mining operations leveraged to silver prices see their equity valuations destabilize. Financial institutions holding silver derivatives begin experiencing counterparty stress, and investors treating silver as a safe haven discover their hedge is becoming their liability. The pattern now visible in silver's charts tells a specific story. It begins with what technical analysts call loss of momentum integrity. This occurs when an asset's price continues rising, but the underlying buying pressure steadily diminishes. Think of it like a car climbing a hill. The engine sounds normal, the speedometer shows forward movement, but fuel consumption is spiking, and the engine temperature is rising. Everything appears fine on the surface, but the mechanical stress is building toward failure. In Bitcoin's case, during early 2020, this divergence became visible roughly 8 weeks before the collapse. Price made higher peaks, but each peak required less actual buying volume. The market was rising on diminishing conviction. Professional traders call this distribution. It means large holders are quietly exiting their positions, while retail participants continue buying. The wealth transfer begins before the price collapse, not during it. By the time the breakdown becomes obvious to casual observers, the strategic positioning has already occurred. Now, examine silver's current technical structure. Over the past 6 weeks, silver has tested resistance levels 3 times. Each test showed weaker buying pressure than the previous attempt. Volume patterns reveal institutional selling disguised within normal trading activity. The options market shows a dramatic increase in protective put buying concentrated among professional market participants. These are not random signals. They form a coherent pattern, a mechanical signature that precedes forced liquidation events. But here's what makes this situation particularly urgent. The derivative structure surrounding silver is exponentially more complex than Bitcoin's was in 2020. Bitcoin operated primarily in spot markets and simple futures contracts. Silver exists within a vast web of paper claims, ETF structures, mining company hedges, industrial supply contracts, and speculative leverage. The paper-to-physical ratio in silver, meaning the amount of paper claims versus actual metal available, currently sits at approximately 250 to 1. This means For every physical ounce of silver that actually exists in deliverable form, there are 250 claims of ownership. The structure remains stable only as long as confidence persists. The moment mechanical price breakdown begins and participants start demanding physical delivery, the entire structure faces a stress test it was never designed to withstand. The Bitcoin collapse of 2020 affected primarily speculative holders. The silver unraveling now beginning carries implications for industrial supply chains, financial institution balance sheets, and sovereign currency markets. The pattern has appeared. The timeline is now active, and most market participants have no idea what's coming. The mechanical unraveling has begun. In September 2008, a currency trader in Singapore noticed something unusual. Silver prices were rising, but the physical metal was becoming harder to acquire. Delivery times from refineries were extending from 2 weeks to 6 weeks. Yet the paper price showed no stress whatsoever. He made a single phone call to a contact at a Swiss vault facility. The answer he received changed his entire positioning. We're seeing withdrawal requests we haven't seen since 1980, but the futures market is trading like it's a normal Tuesday. 3 weeks later, Lehman Brothers collapsed. Silver dropped 42% in 17 days. The divergence between paper markets and physical reality had been the warning sign. Most traders never saw it coming. Today, that same divergence has returned. But this time, the structural fragility is exponentially greater. To understand why silver's current technical breakdown carries such profound implications, one must first understand how modern commodity markets actually function. Silver trades simultaneously in 3 distinct but interconnected spheres: the physical market, where actual metal changes hands; the futures market, where contracts for future delivery are exchanged; and the derivatives market, where financial instruments reference silver's price without any metal ever moving. In a healthy market structure, these 3 spheres maintain equilibrium. Physical demand influences futures prices. Futures prices guide derivative valuations, and derivatives provide liquidity back to physical markets. It's a closed-loop system, designed for stability, but something has fractured this equilibrium. The derivatives market has grown so massive that it now dominates price discovery. Physical silver trading represents less than 4% of total daily silver market volume. The remaining 96% is purely financial engineering. Paper, trading against paper, this creates a dangerous vulnerability. When technical breakdown begins in the paper markets, it can occur completely disconnected from physical supply and demand fundamentals. The price can collapse, even while physical metal becomes scarce. This is precisely what the current pattern is signaling. Examine the institutional positioning data from the past 90 days. Commercial hedgers, the mining companies and industrial users who actually handle physical silver, have reduced their short positions by 38%. This means those who know the physical market best are reducing their bets against silver. Simultaneously, managed money traders, the speculative funds trading purely on technical signals, have increased long positions by 41%. This is the exact inverse of what healthy market structure looks like. The people who know the commodity are stepping back. The people chasing price momentum are piling in. This divergence, the separation between informed participants and speculative flow, creates the conditions for mechanical unraveling. Now layer in the central bank policy dimension. For the past 18 months, global central banks have maintained interest rates at levels designed to support debt markets. But this policy creates a hidden pressure point in commodity derivatives. Silver derivatives, particularly those involving lending and borrowing of physical metal, depend on interest rate stability. When rates become volatile, or when the curve inverts, these derivatives develop pricing stress. The stress doesn't show up in the spot price immediately. It appears first in the options market, in the volatility surface, in the term structure of futures contracts. These are the mechanical indicators that technical analysts track. And right now, every single one is flashing the same warning Bitcoin structure showed in early 2020. But there's another mechanism at work, one most analysts completely miss: the ETF structure problem. Silver ETFs hold physical metal. Theoretically, investors buy shares. The fund buys silver. The silver sits in a vault. Everyone's happy. Except the authorized participants who create and redeem these ETF shares operate with a crucial assumption. They assume that redemptions will follow a predictable pattern. They assume they'll have time to acquire physical metal when needed. They assume the market will remain liquid during stress events. Bitcoin in 2020 didn't have this structural vulnerability. When Bitcoin's price collapsed, it was simply a transfer of digital value from one wallet to another. No physical delivery required, no vault capacity constraints, no refinery bottlenecks. Silver operates under completely different mechanics. If technical breakdown triggers mass ETF redemptions, and those redemptions require physical delivery, the authorized participants face an impossible equation. They must acquire physical metal in a market where price is falling, but physical availability is constrained. This creates what market specialists call a liquidity vacuum. The bid disappears, not because there's no value, but because the delivery mechanism has seized. The pattern now visible in silver's charts suggests this mechanism is beginning to engage. Volume at key support levels shows characteristics of forced liquidation, not voluntary selling. The order book depth is thinning at precisely the price points where ETF hedging activity concentrates. These are not abstract technical signals. These are the fingerprints of a market structure beginning to fail. And the timeline matches Bitcoin's 2020 pattern with disturbing precision. The unraveling is not coming. It has already begun. Most participants are still trading yesterday's market, or while the underlying mechanisms are quietly, systematically breaking down. November 2013, Cyprus. A hedge fund manager sat in his Nicosia office and watching his screens. His fund held 12 million euros in Cypriot bank deposits. The banks were closed temporarily. The government said, "Just a long weekend, nothing to worry about." He tried to wire funds out. The system rejected the transaction. He attempted to withdraw cash. ATMs were offline. 4 days later, when the banks reopened, about 47% of his capital was simply gone, converted to bank equity at a valuation he never agreed to. The technical term was bail-in. The practical reality was wealth confiscation. But here's what haunted him most. 3 weeks before the freeze, a specific pattern appeared in Cypriot bond yields, a mechanical divergence, visible to anyone watching closely. He saw it, recognized it, and did nothing. He assumed he had time. By the time urgency replaced analysis, the exit doors had already closed. This is how wealth destruction actually occurs. Not in dramatic crashes that make headlines, but in the quiet space between recognition and action. The pathway from technical warning to irreversible loss follows a predictable sequence. And silver is now entering stage 3 of a 5-stage process. Stage 1 is pattern formation. This occurred in silver between mid-October and late December 2025. Price made higher highs. Volume showed declining participation. Momentum indicators diverged from price action. Professional traders noticed. Retail participants did not. Stage 2 is confirmatory breakdown. This began in early January 2026. Silver violated key support levels on expanding volume with no immediate recovery. The technical pattern shifted from warning to active deterioration. At this stage, sophisticated market participants begin protective positioning. They don't exit completely. That would be premature. But they hedge. They reduce exposure. They prepare capital for deployment after the collapse. Stage 3, where silver sits right now, is psychological denial. Price has broken support. The pattern is clear, but the broader market refuses to acknowledge the implications. Analysts publish bullish forecasts. Retail buying actually increases. Financial media discusses buying opportunities. This stage is the most dangerous because it creates the false impression that the worst is past. Bitcoin in 2020 spent exactly 11 days in stage 3, from March 1st to March 12th, price choppy, conviction uncertain. But the mechanical pattern continuing to deteriorate. Traders who understood the pattern used those 11 days to complete their repositioning. Those who didn't watched helplessly as stage 4 began. Stage 4 is cascading liquidation. This is where the wealth destruction becomes visible. Forced selling triggers margin calls, which trigger more forced selling, which accelerates price decline, which triggers additional margin calls. The cycle feeds on itself. In Bitcoin's case, stage 4 lasted 9 days. From 950 to $3,800, 63% drawdown. But the wealth destruction wasn't evenly distributed. Retail holders who bought near the top lost capital. Leveraged traders were completely wiped out. Options holders saw positions expire worthless. Mining companies with inadequate hedges faced bankruptcy, yet simultaneously prepared. Capital acquired the same asset at a 63% discount. The wealth didn't disappear. It transferred from those who ignored the pattern to those who understood it. Now examine silver's current position within this framework. The mining sector holds particular vulnerability. 43% of primary silver miners operate with debt-to-equity ratios exceeding 1.5. These companies borrowed when silver was $28 per ounce. They built expansion plans based on 25 plus price assumptions. If silver enters stage 4 liquidation and tests the $18-$20 range, these balance sheets become insolvent, not stressed, not challenged, insolvent. The equity value evaporates. Bondholder recovery becomes the only consideration, and shareholders experience total loss. This isn't theoretical. In Bitcoin's 2020 collapse, 17 mining companies ceased operations permanently. Their equity went to zero, not because Bitcoin died, but because their cost structure couldn't survive the temporary price dislocation. Silver's industrial supply chain faces similar exposure. Electronics manufacturers, solar panel producers, medical device companies all depend on stable silver pricing for margin calculations. Many hedge this exposure through derivatives, but those derivatives are priced based on assumed market liquidity. When stage 4 liquidation begins, liquidity assumptions fail catastrophically. The hedge that was supposed to protect becomes unavailable exactly when it's needed most. Companies suddenly face input costs that spike 40%, while output prices remain fixed by existing contracts. Margins compressed to zero or negative. Production halts. Layoffs begin. The wealth destruction ripples through the real economy, far beyond the commodity market itself. But there's a deeper mechanism at work, the psychological impact on subsequent decision-making. Investors who experience stage 4 liquidation develop what behavioral economists call trauma-based risk aversion. They become unable to re-enter the market, even after prices stabilize. They watch as the asset recovers, but cannot overcome the psychological barrier created by the loss experience. Bitcoin demonstrated this perfectly. After the March 2020 collapse, Bitcoin recovered to new all-time highs within 8 months. Those who understood the pattern and bought the liquidation generated returns exceeding 300%. Those who sold during stage 4 or who were liquidated missed the entire recovery, the initial wealth destruction compounded by the opportunity cost of psychological paralysis. Silver's pattern suggests the same sequence is now inevitable. The timeline remains uncertain, but the pathway is clear. Stage 3 denial will transition to stage 4 liquidation. The question isn't whether, the question is when, and whether you're positioned on the transferring side or the receiving side of the wealth destruction pathway. The pattern doesn't lie, it simply executes. April 2020, London. A portfolio manager received an encrypted message from a contact in Hong Kong. The message contained 3 words. It's happening again. No context, no explanation, just those 3 words. He immediately opened his terminal and examined gold futures volume. What he saw made his hands go cold. The exact order flow signature that preceded the 2013 gold flash crash was reappearing. He had 17 hours before Asian markets opened. Well, he made 4 phone calls, repositioned $23 million in client assets, and waited. 31 hours later, gold dropped $170 in 14 minutes. His clients were protected. Most of the market was not. The difference between wealth preservation and wealth destruction wasn't information. Everyone had access to the same charts, the same data, the same technical patterns. The difference was belief. He believed the pattern would execute. Others hoped it wouldn't. Hope is not a strategy. Silver's current technical structure much presents the same choice. Believe the pattern or hope against it, but time is no longer abundant. Based on Bitcoin's 2020 timeline and the correlation to silver's current formation, the window for strategic positioning is narrowing rapidly. Let's establish the critical timeline markers. Bitcoin's pattern, from first divergent signal to full liquidation event, spanned 63 days. Silver's initial divergent signal appeared on December 11th, 2025. Counting forward 63 days places the potential liquidation window between February 8th and February 20th, 2026. We are currently in day 40. 23 days remain in the historical pattern window. This doesn't mean liquidation must occur within 23 days. Patterns extend, compress, or occasionally invalidate. But probability heavily favors pattern completion. Within 30 to 45 days from today, now examine the critical price levels that confirm or deny this analysis. Silver's primary support structure rests at $28.40 per ounce. This level is held on 3 separate tests over the past 19 months. If this support fails, on volume exceeding the 20-day average, the pattern confirmation becomes mathematically certain. The next support level sits at $24.80. This represents the 50% retracement of the entire 2024-2025 advance. Bitcoin's 2020 collapse retraced 63% of its prior advance. Applying the same percentage to silver's structure, targets $21.50. This isn't prediction. This is pattern-based probability analysis. If stage 4 liquidation begins, these are the mathematical targets the market structure suggests. But here's what most analysts miss. The opportunity doesn't exist in predicting the exact bottom. The opportunity exists in understanding the post-liquidation recovery structure. Bitcoin's pattern showed a V-shaped recovery beginning within 72 hours of the liquidation low. The asset that collapsed 63%, recovered 41% in the following 11 days. Those positioned with capital during the liquidation window captured returns that exceeded normal market conditions by a factor of 12. This is where wealth transfer becomes wealth multiplication. Silver's industrial demand structure suggests a similar recovery pattern is probable. Unlike Bitcoin, which is purely speculative, silver has genuine industrial consumption, solar panel manufacturing, electronics production, medical applications. These demand sources don't disappear during price liquidation. They simply pause, waiting for stability. When price stabilizes post-liquidation, industrial buying resumes immediately. This creates a natural recovery bid that speculative assets lack. The strategic positioning question therefore becomes temporal: reduce exposure now, preserve capital, deploy during liquidation, or maintain current positions, accept drawdown risk, and hope for pattern invalidation. Each choice carries distinct consequences. For business owners, the implications extend beyond investment portfolios. Silver price volatility impacts input costs, affects hedging strategies, and influences vendor relationships. A manufacturing company with 90-day silver supply contracts faces margin compression. If spot prices spike during physical shortages, even as futures prices collapse, the strategic response requires understanding both the paper market pattern and the physical delivery mechanics. Some businesses should increase physical inventory now, before potential delivery constraints emerge. Others should extend contract durations, locking current prices before volatility expands. The correct strategy depends on business model specifics, but the underlying urgency applies universally. For entrepreneurs evaluating capital deployment, the pattern offers clarity. Venture capital becomes more expensive during commodity market stress. And prepare for acquisition opportunities that emerge post-liquidation. Market dislocations create valuation disconnects. Quality assets become available at distressed prices, but only to those with available capital. The wealthy become wealthier during liquidations, not because they're lucky, but because they're positioned. Now consider the psychological preparation required. Watching an asset collapse, even when you predicted it, creates emotional stress. The human mind struggles with certainty in the face of chaos. Doubt creeps in. What if I'm wrong? Should I exit now? Is it too late? These questions destroy more wealth than the market move itself. The Cyprus hedge fund manager, from our earlier example, later revealed his secret. He wrote down his analysis, his price targets, his exit strategy before the crisis began. When doubt emerged, during the chaos, he simply reread what he'd written when his mind was clear, and he followed it. Mechanical execution of predetermined strategy separated him from those who panicked. Silver's pattern demands the same discipline. Decide now what your response will be to specific price levels. Write it down, make it concrete. Remove emotion from future decisions. If silver breaks $28.40 on volume, you do X. If it reaches $24.80, you do Y. If liquidation occurs and price touches $21.50, you do Z. The strategy exists before the chaos, or it doesn't exist at all. The final consideration is the cost of inaction. If the pattern executes and you're unprepared, the wealth destruction is immediate and irreversible. If the pattern invalidates and you position defensively, the cost is opportunity, not capital. Asymmetric risk. The pattern has appeared. Bitcoin's 2020 warning has returned in silver's structure. The mechanical unraveling is already in motion. The timeline is active, and the window for strategic positioning is closing, not in months, in weeks, perhaps in days. The choice is no longer whether to act, but whether you act, while choice remains possible. Or wait until the market makes the choice for you. The pattern is indifferent to your decision. It will execute regardless. The only question that matters now is which side of the wealth transfer you'll be standing on when the technical unraveling reaches completion